Consumers' job fears sent the Conference Board's expectations index plunging to its lowest level since 2011. It's now nearly 30 points below the board's recession threshold. No wonder interest rates are dropping, with Treasury yields falling sharply. In fact, the 2-year is down to its lowest rate since early October. People aren't rotating out of US dollar assets or away from US Treasuries. They're buying them for the same reason that consumer confidence is falling. The economy was never strong and resilient. It was weak and fragile, even before getting to this year. That's the reason why any tariff shock is producing these extreme results coming in from all over the place. The Bureau of Labor Statistics perpetually overstates its job opening series, but that one also dropped by almost 300,000 in the month of March too. However much and however measured, everything keeps pointing to a sharp fall in demand for workers. And American workers know it too, which is why the share of consumers expecting fewer jobs in the next 6 months soared to nearly equal April of 2009. We keep seeing these extreme comparisons. And for good measure, yet another Fed PMI absolutely crashed here in April, the last of the group which sent the monthly average plunging to its lowest value since 2020. And that one is for the services sector too. According to the Atlanta Fed's GDPNow model, Q1 GDP is on track to be sharply negative, and that's already accounting for the massive gold flows. Even economists, always reluctant to deviate from the Federal Reserve, they've been busy lowering their forecasts too. What we're really starting to see is what happens to a fragile system when it encounters one too many negatives. From the artificial high last year, which seems a distant memory, the sharp loss of economic momentum indicating a payback period that seems intent on zeroing in on people's jobs. Of course, rates are going to drop. Pay no attention to all those screaming about rotating out of dollar assets or ditching the dollar and dropping treasuries. Market rates are about economic and monetary fundamentals, not the nonsense you see in the mainstream. Notice how everything said in the mainstream ties interest rates and yields to some central bank or some central government. That's not how this works. That's simply how they want you to think it does. So where we are with the US Treasury market today, after everything that's come in over the last couple of days, last little while, today in particular, the 2-year Treasury note down to 3.66% in yield for what would be its lowest rate since October 2nd. And even the 10-year Treasury bond, that one is falling too. The yield is falling. 4.18% before I started recording here. It's getting closer to the April 4th low of 4.01%, certainly backing away from the high around 450 when everybody was screaming about how the Trump administration was destroying the Treasury market and forcing the world to ditch the dollar. Most of that is partisan nonsense that you can set aside. Treasury rates in the Treasury market are fundamentals. They're picturing and perceiving what's happening in the real economy and the monetary system and coming up with interest rates based on those. So what we're seeing is basically confirmation that what had sent rates higher earlier this month wasn't ditching the dollar, rotating away from treasuries. It was simply the basis trade and foreign reserve managers who were forced to sell when confronting the dollar shortage that screwed up the repo market. In the absence of an acute dollar shortage, which gums up repo, you don't have leveraged basis traders that are selling their treasuries, therefore forcing yields up for technical reasons, not for fundamental reasons. As soon as the basis traders stop selling, rates go back down because the fundamentals demand lower growth, lower inflation, lower interest rates. But that's not what you hear. No one wants to admit this because it reflects so poorly on economists and the Federal Reserve. What you hear in the mainstream is about how interest rates are a combination of Fed policies and government actions, geopolitics and treasury supply. They even made up some math to try to give this stuff some cover, something called term premiums, which, by the way, I've covered a couple of times in detail at Eurodollar University's deep dive analysis. You have to understand what term premiums are, what they intend to accomplish. But for our purposes here, all they are is really just another way to look at the yield curve and make up some math so that they can interpret the yield curve signals in a way that's friendlier to the Federal Reserve. That's what the math is really for, to change what is really a straightforward interpretation of the yield curve into something which sounds friendlier to the Fed and economists and central governments. In fact, here's an example just from a couple days ago. In Bloomberg, there was this headline from Sunday night. Treasury market's new world order brings fear of long bond. You have to laugh at this stuff. And then the very next day later, stocks rise as Fed rate cut wagers sink Treasury yields. And it's not really Fed rate cut wagers that are sinking Treasury yields. It's the fundamentals I keep saying. It's the fundamentals in the real economy that aligns with what consumers are seeing and now saying about prospects in the labor market, jobs and incomes first and foremost. So falling Treasury yields, not necessarily about the Fed, except that the market is betting increasingly the Fed will have to react to the weakness by lowering interest rates. Interest rates are not stimulus, they're information about the state of the world. And lower interest rates, that suggests nothing good is happening today, and even worse might be happening down the road. And you can tell the lower rates in the cash treasury market aren't really about the Federal Reserve. Just look at term SOFR futures. Term SOFR futures aren't moving nearly as much as Treasury yields are, especially at the 2-year maturity or even the 10-year maturity. What that says is that the marketplace, the wider marketplace, is still pricing short-term reluctance on the part of the Federal Reserve to ditch their narrative about inflation and tariffs creating tremendous amount of uncertainty, and that over time, eventually the Fed will be forced to confront everything that's showing up right now today. So market rates are going down because of the economic fundamentals. And eventually the Federal Reserve seeing the light and being forced to reckon with all those fundamentals, and eventually at some point coming to grips with them by lowering short-term interest rates after the longer-term part of the yield curve has already fallen farther than it is. And again, this is the fundamentals that consumers as workers are seeing in their own way from their own perceptions. Consumer confidence and these consumer confidence indexes, well, a lot of people make them out to be about consumer spending, and they can be, as I keep pointing out, they're more so a reflection of perceptions of the overall economy, but starting with jobs and incomes. And that was certainly the message that we got from the Conference Board, which today reported an utter plunge in consumer confidence, another utter plunge in consumer confidence. And the Conference Board's index tends to be the more optimistic of the group. So the fact that the consumer confidence numbers from the Conference Board are behaving in this way, that's another signal and sign altogether. Their confidence index fell to 86.0, which is down another 7.99 points. This is for the month of April of 2025. At 86.0, that's the Conference Board's lowest since May of 2020. And we keep hearing these comparisons, lowest since 4 years, lowest since 2011, lowest since 2008, 2009. While the current index from the Conference Board was only down a little bit at 133.5, again, it's the most optimistic of all surveys, what's really got consumers worried is the near-term expectations for what's happening in the labor market. The Conference Board's expectations index, as I said in the introduction, fell to 54.4, which was its lowest since October of 2011. That's lower than any point during 2020 and the pandemic. And it is, as the Conference Board itself pointed out, well below the 80 threshold, which it has established for recession. When consumers become this pessimistic about the short run and intermediate term, it's usually because they're foreseeing recession, full-blown recession conditions in jobs and income prospects. In fact, that's what the Conference Board press release itself singled out. It said, notably, the share of consumers expecting fewer jobs in the next 6 months, 32.1%, was nearly as high as in April 2009, right in the middle of the great not recession. In addition, expectations about future income prospects turned clearly negative for the first time in 5 years, going back to the pandemic and the lockdowns, suggesting that concerns about the economy have now spread to consumers worrying about their own personal situations. And that's the part where it gets into consumer spending. Consumers get afraid about employment prospects and therefore their own incomes. But once they start to think that that's going to impact them, maybe they're no longer worried about it down the road. It's getting closer and closer. There's more and more to worry about. Then they start seeing it in their own personal finances. And when they do, they tighten their wallets and pull back in spending. And that leads to the vicious self-reinforcing cycle that we all associate with the full-blown recession. Worries about the economy and jobs lead to a pullback in spending. The pullback in spending leads to the realization of lost jobs and incomes, which forces more consumers to pull back, and on we go. So what consumers are saying, and it's not just the Conference Board survey. We talked about the University of Michigan, the RCM survey, all of them, they're all showing the same thing. The Federal Reserve Bank of New York's own surveys of consumers, they're all worried about jobs in incomes. They can feel it coming. It's the same thing that we talked about in yesterday's video with the Federal Reserve's Beige Book. The Beige Book in January said layoffs are rare, and then April it says, well, now we're hearing scattered reports of layoff plans, as well as in the New York region anyway, scattered reports of actual small companies laying off workers due to the uncertain economic environment that isn't uncertain, is actually becoming more and more certain as we go along here. That's what the bond market is saying too. Since most of this pessimism is focused on jobs, this loss of economic momentum, the importance of labor market statistics in telling us where the job market might be heading to. I mentioned also in yesterday's video the Beveridge curve. And part of the Beveridge curve, the y-axis, comes from Jolts job openings. And while the job openings series itself is questionable, all of its flaws, it is questionable and flawed in a way that makes it overstate the case for the job market and labor demand. Therefore, it presents us a very conservative view, a very optimistically conservative view of the labor market. And so what we're looking at for the Beveridge curve, as I mentioned yesterday, is the transition, a potential transition, more evidence for a transition from the vertical part to the flat part. You never want to be on the flat part of the Beveridge curve because that's when demand for labor has fallen so low, when the general economy has weakened so much that employers don't even have enough demand for the workforce that they have on staff right now. And if that's the case, they've no longer stopped hiring, they've begun to fire, which is exactly what consumers are saying that they're worried about, not at some distant date, but more and more about today. And the job openings number from Jolts for March of 2024, remember Jolts is a month behind payroll, so it's just now catching up to where payrolls were earlier this month. So the job openings level for March of 2025, 7.19 million, which is down nearly 300,000 from February and very nearly matches the recent low set last September. So what that suggests for the Beveridge curve is, however you want to measure labor demand and job openings, here's the most optimistic take of it. It is still continuing to go down and getting weaker and weaker all the time. The rest of the Jolts numbers equally concerning for different ways. The hiring level is one thing that we keep pointing out with Jolts, and it's really the number you want to pay attention to. That one improved again, but it didn't really improve. It's basically been flat for about 6 months now. 5.41 million in the month of March, and it had been 5.37 million in each of the 3 months before March, and even 5.35 million going back to October. And note, this is the period when the economy went through the artificial high. So what the Jolts number, the hiring estimates tell us is that during this artificial high, hiring didn't do anything more than stabilize. It was declining and falling off and decelerating last summer, heading into the artificial high, and at best, at least according to the Jolts numbers, it stabilized and steadied, but then the payback period hits and the hiring rate will end up looking like, very likely, end up looking like what consumers are worried about. Quits increased simply, that's a lot of it has to do with Doge and the government sector. Layoffs, according to Jolts, were actually low, and we have to question what they're picking up there. A lot of the stuff is questionable to begin with because it's benchmarked to the establishment survey. But either way, from the most optimistic take on labor demand, the job opening series, it fits with the economy that's heading on the vertical part of the Beveridge curve at the very least, getting lower and lower into that danger zone where it potentially transitions to the flat part, which is that's exactly what consumers keep telling us they're worried about. Not in the terms of the Beveridge curve or the flat part or anything like that, but the conditions in the general economy that are consistent with what we're seeing on the Beveridge curve, potentially. The danger zone becoming more than just some future worry. It's happening maybe right now. Even economists, Wall Street economists, who do not want to deviate from the Fed. The Fed's still strong and resilient, so Wall Street economists, they're going to put their forecast together that looks strong and resilient. They don't want to downgrade them unless Jay Powell does it first. But even economists are being forced, when confronting all of this data and evidence that's coming in from all these different places and from all sides, they're forced to lower their estimates anyway. According to Bloomberg, the U.S. economy is set to expand 1.4% in 2025 and 1.5% in 2026, according to the latest Bloomberg survey of economists, compared with 2% and 1.9% in last month's poll. The median respondent now sees a 45% chance of a downturn in the next 12 months, up from 30% in March. And as I pointed out in a recent video, any calendar year that shows GDP growth, real GDP growth below 1.5%, really 1.3%, is more likely than not, in fact, very likely to have a recession in that calendar year. So the fact that these economists surveyed by Bloomberg are forecasting a 1.4% calendar year number raises the probability already too high that there's a recession in this calendar year. That's what they're actually saying without actually saying it. In more immediate terms, the Atlanta Fed's GDPNow tracker, that one, the final reading before GDP comes out tomorrow from the Bureau of Economic Analysis, the Atlanta Fed's final tracker reading was minus 2.7%, but that includes a lot of distortions due to gold inflows. The Bureau of Economic Analysis doesn't count gold inflows, non-monetary gold inflows, in its GDP estimates. So the Atlanta Fed adjusted for these gold flows, and that fell to minus 1.5%. So what the Atlanta Fed is saying the day before GDP comes out for the US is that they think it should be around minus 1.5%. And remember, this is for the first quarter of this year. This is before we even get to the tariff shock, or at least the majority of the tariff shock. This is the first quarter when we had the fragile economy confronting more so the payback period than anything else. So assuming that's correct, and GDPNow does have a spotty track record, but assume it's anywhere close to the ballpark, what they're saying is that the economy lost a ton of momentum even before we get to the potential tariff shock and the impact, the concrete impact on the labor market. So we have all of these forward-looking indicators from all over the place, consumer confidence, and a bunch of others, including the Federal Reserve's regional surveys. All of these forward-looking indicators saying GDP output, the economic climate in the first quarter, not so good, a lot of artificiality, then the payback, and then the tariff shock. And then the forward indicators are even worse going into the rest of this year. So it's all pointing toward a rising probability of exactly what interest rates have been pointing for this entire time. And as I mentioned in the intro, we got one more PMI to complete the month of April from the Fed regional branches. This one was the Dallas Fed's service sector survey, and it also plunged to minus 19.4, down from minus 11.3 in March. That was its lowest level since October of 2023, and the third lowest overall for the measure since 2020. And it had been plus 10.8 back in December. So again, you see the artificial high last year in all of these numbers, and then the sharp loss of momentum throughout the first quarter, entering the second quarter before we even get to the vast majority of the second quarter. The Dallas Fed's future index, minus 16.0, down from minus 1.1 in March. And it had been plus 31.2 in January. So service sector providers in Dallas and in Texas, they were incredibly optimistic in January, and then a 47-point plunge since then, which brought the measure to its lowest level since June of 2022, back in the initial phase of the oil price shock. So with the publication of the Dallas Fed's PMI for April, we now have the 5 service sector PMIs, and the average of those 5 is minus 22.1, which is another new cycle low, another one that's lowest since 2020, and it fits with everything else that we're getting. Forward-looking indicators saying, first of all, business isn't great now, but looking ahead, everyone expects it to get some degree worse. The question now is, how much? Businesses and these PMIs from the regional Fed surveys, not overly optimistic, nor are consumers who are looking at the job market and saying, well, it isn't terrible right now, but we keep hearing things, we keep seeing things, we keep talking to other people, and we don't think it's going to hold this way for very long. So consumers are worried about their jobs because they know what's likely coming. The demand for labor, which has been falling for some time already, remember the inflection last year around March and April. So demand for labor was already weak. The economy was already fragile to begin with, even if we don't know just how much because of the flawed measures that we have in front of us. And of course, interest rates are going lower in this situation. They price on fundamentals, not the Fed. The Fed interferes, but it's not the Fed. It's not central governments. It's not geopolitics. It's not supply of treasuries. It's fundamental growth and inflation expectations. It's fundamentals about monetary conditions. That's what drive interest rates. And interest rates, given everything that we see here, they want to go lower too. The more the Fed looks like it's going to get out of the way, the lower rates are going to go. As long as we don't have another dollar shortage that interrupts the repo market and forces basis trade selling, even the long end of the yield curve is heading in that direction too. Markets have been saying all along, rates are going to go down by a lot and stay there a lot longer. We aren't there yet. That's the good thing. Confidence and sentiment, these are still about future conditions and things that might not happen, but the probabilities are all rising to the point that it's getting more and more uncomfortable. We've already paid for some of the pandemic and the lockdowns thus far in the form of lost purchasing power as well as lost jobs, jobs that never came back. What has everyone so pessimistic, the fragility, forgot how to grow, is the realization that there's more to pay for, and that bill may finally be coming due. A lot of the chatter about the Treasury market stems from a misunderstanding, first of all, about fundamentals of interest rates, but also what happened to drive rates up when they should have been going lower. Went over the basis trade mechanics and what it really means in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.